Good evening, everybody, and welcome to tonight's edition of Women and Money Montreal. My name is Lynn Sock. For those who are attending for the first time, welcome. I just wanted to give you a little bit of background of the group and the formats for this evening. Women and Money Montreal began back in 2020, actually almost 4 years ago, and it started off as a Facebook group where women would come together and increase their level of financial literacy. I've been offering these weekly sessions since about 2021, and tonight's actually our 123rd session that we've held, always on Tuesday, always at 7 p.m. And tonight is our final weekly financial literacy session for 2024, and we're going to talk about the question of the year, which is rates and rates, mortgage rates, variable rates. For those who I haven't had the pleasure of meeting yet, I am an independent financial security advisor licensed in the province of Quebec. In the past, I've also held a license as a mutual funds dealer representative and a mortgage broker, which I'm actually going to let go of at the end of this year. I am the founder of Linsock Services Financiers Inc. So our firm, we're a team of 6, and we provide solutions that cover insurance, investments, or mortgages. So at the end of the session, if you do have any questions or want to talk about your particular situation one-on-one, feel free to reach out with me and I'll get you in touch with one of the mortgage brokers on our team. As far as the format is concerned, if you are visiting from meetup.com for the first time and you haven't joined our Facebook group, I do encourage you to join. It's under the same name, Women and Money Montreal. We do a lot more interaction in the group versus on Meetup. We will resume on the first Tuesday in January, which I believe is the January the 7th. Again, Tuesday, 7 p.m. So the format's pretty simple. I'm going to discuss the topic of the week, which is mortgage rates. If you have any questions or comments, please feel free to put them in the chat, and I always encourage people to ask your questions. I repeat it over and over every week. If you have a question, please don't feel shy to ask, because chances are if you have a question or is there something you don't understand, somebody else who's either watching live or watching the recording later on probably is asking themselves the same thing. So please do not feel shy. Ask the questions in the chat. Moving forward, if you do register for any of these sessions, even if you don't attend live, by registering, you will receive a copy of the video recording by email immediately following the session. If it doesn't land in your inbox, please check your spam folder. And then there's also a follow-up email with a summary of some other things that might not just added tools or resources that might be of interest to you. So I just like to check to see if there are any comments in the chat, and there's nothing. So tonight's topic is probably one of the biggest questions that's been going on all year: rates. Tonight, we're specifically going to talk about, is it time for you to choose a variable rate mortgage? And like I do every week, I like to start off with just the basics. The people who are attending come at all different levels. Some have never owned real estate before or are thinking of buying a home. There are others who are realtors who watch this later on. We all come at different levels, but I always like to repeat the basics, because without understanding the basics, it's hard to wrap your head around more advanced concepts. So I wanted to start off tonight with just some basics about fixed and variable rate mortgages. And I'm going to cover 4 terms that you need to know before we advance. So even before we get into fixed and variable rate mortgages, 2 mortgage terms that are important to understand are amortization and term. So your amortization period, the amortization period of a mortgage, is the entire length of your mortgage. Typically in Canada, the most common amortization period is 25 years. So usually people will choose 25 years to pay off their mortgage. It's the entire length of your mortgage from A to Z. Now, it's not the only amortization period that's around. You could choose 10, you could choose 15, you could choose 20, but like I said, the most common type is 25 years. Prior to this Sunday, actually, if you were buying a first home and your down payment was less than 20%, the maximum amortization period you were allowed to have was 25 years. If you were putting at least 20%, then you could go up to 30. There are some instances where you could even go up to 35 and 40. 40 is rare. It's available through private lenders in Ontario, but they're rare. Maybe one day they'll be more common. They used to be more common in the past. So amortization period is the entire length of your mortgage, how long it's going to take for you to pay off your mortgage. And your amortization period is broken up into terms, with 5-year terms being the most common term that Canadians and Americans choose. And what happens is when you choose a 5-year term, every 5 years, you will renew your mortgage based on the mortgage terms and conditions that are available at that moment. Now, if let's say you were buying a house today and you chose a 5-year term today, and in 5 years, when you're shopping around, you're better off taking a 3-year term, you're allowed to do that. So amortization period, the entire length of your mortgage, and your amortization period is broken down into smaller terms, 5-year terms being the most common, but you could also choose 1 year, 2 year, 3 year, 4 year, 5 year. You could even choose 10-year if you wish, which I had a couple of clients this year for the first time ever asking me about 10-year amortization periods. So that's the basics when it comes to the mortgage contract itself. When it comes to fixed and variable rate mortgages, fixed rate mortgages are pretty straightforward. A fixed rate mortgage means that the terms and conditions and the rate of your mortgage will stay the same for the entire length of your term. So if you take a 5-year term and you're offered a rate at 4.5%, your interest rate is going to remain the same during the entire term of your mortgage. At the end of your term, or when your term is up for you're coming close to the end of your term, that's where you're going to receive a renewal offer from your current lender, and or you could shop around to see if there are any other better offers that are available to you. So fixed is pretty straightforward and it's the most common type of mortgage that Canadians choose. The variable rate mortgage, the rate will fluctuate during the term of your mortgage. And usually there are 2 types of variable rate mortgages. One type of variable rate mortgage is when the rate changes throughout the length of your mortgage, and your payments also changes depending on the rate changes. The other type of variable rate mortgage is when you have a static payment throughout the term of your mortgage, and at the end of the term, if there's any amount owing or there's a difference, then your lender will tell you how much you owe at the end of the term. So those are the key points, how the fixed and variable rate mortgages work. Fixed rate is more popular because people like to know what their payments are. People like routine. They like to know ahead of time, every month or bi-weekly, I'm going to pay $2,000 a month for my mortgage. Variable rate is more common with real estate investors who own rental properties, mainly because they could write off the interest on their mortgage payments. Variable rate mortgages are also more common for people who are just bigger risk takers. In general, if you look at the entire amortization period of your mortgage, so if you look at all the years that you've paid off your mortgage and you look at the difference between fixed and variable rates, generally speaking, you'll win if you always take a variable rate, because usually variable rates are lower in the long term than fixed rates. However, on the flip side, the majority of people like stability, and the thought of having a variable rate that fluctuates is scary for a lot of people. And the thought of having a variable rate that is higher than a fixed rate is even scarier, which is what we have been going through the last few years. So at the beginning of COVID, when the beginning of COVID, the beginning of the pandemic, basically what all central banks did is they dropped their overnight lending rate, which caused this big drop in mortgage rates overall. And people were excited. I don't know if you remember, but everybody was experiencing FOMO. Everybody wanted to buy their first home, or everybody wanted to invest in property because interest rates were so low. Now we're in a period where obviously, what goes up must come down. So when interest rates were down in 2020, 2021, they started going back up in 2022, to the point that for the first time in a while, variable rates were a lot higher than fixed rates. What's happening at this moment is that because the rates have started to drop, the spread or the difference between the fixed rate and the variable rate is a lot smaller than it has been over the past couple of years, which is why people are starting to ask now, is now a better time to take a variable rate mortgage, because rates are supposed to go down. And that's precisely why we are here this evening. But before we get into that discussion, I wanted to make sure that everybody understood the difference between amortization and term, as well as fixed and variable rate mortgages. Another thing I wanted to address is that there's a misconception that when the Bank of Canada makes their rate announcements, which was their last rate announcement was last week, it does not affect all mortgages. The Bank of Canada's rate announcements only affect variable rate mortgages. Fixed rate mortgages can change at any time because they go according to, in general, the Government of Canada's 5-year bond yields. So just very simply, a bond is a type of investment. It's basically the government who is asking us as Canadians to invest in them. And if we as regular people invest in Canada, in return, they're going to offer us an interest rate for believing in them and for lending us the money. So the 5-year Government of Canada bond yield basically is kind of like the what mortgage lenders will use to determine what their fixed rates are. So in general, since the beginning of this year, the bond yields have gone down and the fixed rates have gone down, with the exception of at the end, it's been a few weeks, there was a peak with the bond yield rates, the bond yield returns. So you kind of saw like a little bit of an increase with fixed rate mortgages, but now we've kind of stabilized. But in general, if we look at from last year to this year, fixed rate mortgage rates have gone down, as well as variable rate mortgages. So those are some basics that I wanted to cover first before we get into, what you should do and your specific situation. We have a question in the chat. When your mortgage is up for renewal, let's say in 5 years, is only the rate up for negotiation or also the amortization period? Can it be shortened if we wanted to? Excellent question. At the end of a term, all of that is up for negotiation. So people will change their amortization period for many reasons. What I'm seeing a lot of now is, unfortunately, due to COVID, many people went into debt. So as their mortgages are coming up for renewal now, what they're doing is they're refinancing their properties, their homes, in order to pay off some of this consumer debt that's at a higher interest rate, and therefore extending their amortization period. You could also choose to shorten it if you want. That's all up for negotiation at the end of the term. And in fact, if you're in the middle of a term, for the most part, you could also negotiate, but just keep in mind that there will be a penalty that you pay if you're breaking your term, if you're asking for this negotiation in the middle of your term. Also, another thing is, if you break anything within a mortgage contract, don't forget you'll need to go back to the notary. So this includes refinancing, changing the amortization period, changing a lender. You'll need to go back to the notary. So what I tell people is, if you are looking at your options, if your mortgage is up for renewal, and you're checking out other lenders because you're not satisfied with your current lender, if you want to refinance your property in order to pay off some debts that have a higher interest rate, whatever changes you want to make, try to do it all at once, because you'll have to go to the notary anyway, and you might as well do it all in one shot. But absolutely, you could change. You can negotiate at the end of your term, or even in the middle of your term. But in the middle of a term, there will be a penalty that you pay. Someone else is asking, my mortgage is due for renewal at the end of 2025. I had it locked in at a really low rate, so I'm not sure what the best strategy might be. Should I keep waiting it out before getting a fixed rate? Also, I wanted the longest term possible, example 10 years, but I couldn't get that. Are the best rates usually only for 5 terms? Great question. So if your mortgage is up for renewal a year from now, I would say just keep unless there's something else that you need to get done other than renewing your mortgage. So like I brought up, if you have debts to pay, just keep an ear out of what's going on with mortgage rates. In general, they're probably going to continue going down a little bit more and then stabilize. That's what should happen. As you'll hear often from mortgage people, we don't have a crystal ball. We can't predict a global pandemic or anything like that. But generally speaking, rates should go down a little bit more, and I believe they should stabilize. I don't think we'll go back to, the interest rates at 1.5% like we did in 2020, 2021. They'll probably go down to about 3-ish%, which is generally speaking the norm when it comes to mortgage rates. So I would say just keep an ear out unless you want to do something else other than just a straight renewal of your mortgage. Now, in terms of should you go with a variable or fixed rate, I actually have some calculations coming up to help people decide if you should go with a fixed or variable rate. Hard to say now, because we are a year off, but just to give you a general idea of dollar-wise what it comes out to if you go with a fixed versus a variable. Other question is also, I wanted the longest term possible, but I couldn't get that. Are the best rates usually only for 5 years? Generally speaking, yes, but I will tell you that there was a period, and the last summer to this time last year, stretching to the beginning of this year, where the 3-year fixed term was actually the best rate on the market, because that's what the market was asking. So it's all about supply and demand. Generally speaking, if you're looking at history, the 5-year terms are usually the best rates, especially the 5-year fixed, unless you're looking at the variable. But there are some exceptions, like I said, because of what happened in the market. I think it was last summer until maybe the beginning of this year, the 3-year fix was the lowest rate on the market. Now it's the 5-year fix that's the lowest rate on the market. Great questions. If there's anything else, please pop them in the chat. So before we get into the numbers that I had, I also wanted to bring up some of the recent changes that took effect this Sunday, December the 15th, for first-time home buyers in Canada. I wanted to bring it up because it does play into some of the calculations that I'm going to go over in the next step. So 2 major changes for first-time home buyers in Canada. The first one is amortization periods, which I brought up earlier. Amortization periods, the amortization period for a first-time home buyer with an insured mortgage has been extended up to 30 years. So before Sunday, if you're a first-time home buyer and your down payment was less than 20% of the purchase price, the highest amortization period that you could get was 25 years, except between August of this year until Sunday, if you're purchasing a brand new construction, you were allowed to go up to 30 years. So as of this past Sunday, you're buying your first home, you're putting less than 20% down payment of the purchase price, you are allowed to have an amortization period of up to 30 years. I'm a big fan of this, mainly because cost of living has been an issue with a lot of Canadians. And the benefit of this is that when you extend the amortization period for a longer time, your payments decrease. So it means more cash flow in your pocket. There are people who are from the other school of thought where this isn't a good idea, and that if you can't pay it off in 25 years, you shouldn't consider buying a home. There's all kinds of differences of opinion that are out there. The key is, if you're a first-time home buyer and you're putting less than 20% down, you are allowed to choose an amortization period of up to 30 years. This was already available for people who are putting at least 20% down, by the way. The second change that happened is that the maximum purchase price for insured mortgages has increased to $1.5 million. So prior to Sunday, December the 15th, if you were purchasing a property at $1.5 million, that's the purchase price, you weren't eligible to have an insured mortgage, meaning that you would have had to put at least a 20% down payment. The reason why the government increased the maximum purchase price is because that's just how much properties are. Here in Montreal, I mean, you could still kind of get away with purchasing homes for under $1 million, but when you start going out to Toronto and Vancouver, you're not going to find anything halfway decent for under $1 million. So the government had no choice to finally increase the maximum purchase price for insured mortgages to $1.5 million. And basically what that means is that if you're purchasing something, if you're purchasing a home and it's worth up to $1.5 million, you're allowed to put a down payment of less than 20%, which means that you'll have what's called an insured mortgage, and you'll have to pay the mortgage insurance premium. So those are the two big changes that took effect as of this past Sunday, December the 15th. I'm very good with those changes. Again, if you look online, if you ask other people, they might have differences of opinion. I think this is kind of getting with the times. You know, a lot of people can't afford to pay off their home in 25 years. And if you look at the price of real estate, it's not uncommon to find a home that's over $1 million. And you as a person, back in the day, if you were buying a house that was worth $1 million, you would think that the person who's buying is rich. That's not necessarily the case anymore, especially if you go in certain areas of Montreal, but especially if you go to Toronto or to Vancouver. So these are things that are going to change. Now that we have all that technical stuff out of the way, if you don't already have a pen and paper, please grab one, because I'm going to go over a bunch of numbers with you. I did some calculations in different scenarios for you to just get a roundabout idea of what the costs are, how much is this scenario going to be if I go with a fixed versus a variable rate, if I go with a purchase price of this much. So I'll give you guys 30 seconds to grab a pen and a paper so you could write this down. As of right now, if you're wondering about the rates, 5-year fixed, and I'm talking just insured mortgages right now, meaning purchases where you didn't put at least 20% down. So you're putting less than 20%. 5-year fixed insured mortgages are around the 4.25%, so 4.25%. We'll make it easy and call it 4.25%. 5-year variable is about 4.5%. So as you can see, the difference between 4.25 and 4.5, it's only 0.25%. There isn't a huge difference as it once was. If we look at even at the beginning of this year, at the beginning of 2024, the 5-year fix was about 5%, and the 5-year variable was about 6%. So there was about a 1% spread between the two, a much bigger difference than now. So people are really, whether you're buying or your mortgage is up for renewal, people are really asking themselves, what's the dollar amount difference? So we're going to go over scenario 1, and this is a purchase scenario. It's kind of a typical scenario that I see with clients in Montreal, South Shore, Laval. And I'll just give you some numbers based on a first-time home buyer and a typical situation that I see on a weekly basis. So I'll have a client or clients in front of me. So whether it's a single person or a couple, their income is $150,000 a year. Again, it could be one person making $150,000 a year, or two people combined making $150,000 a year. They're interested in purchasing a home at about $750,000. They want to put a small down payment. So they want to put a down payment of about 6-7%, which in dollar amounts is about $45,000 to $50,000. And they would like to go, because they're first-time home buyers, they would like to go with a 30-year amortization period. If they go with a fixed rate 5-year fixed rate mortgage, we're looking at a mortgage payment of about $3,400 and change a month. Based on the numbers that I just provided, they do qualify for this mortgage, but they're really at the limit when we do the calculations and look at their debt ratios. So they're really a la max. They can't. There's not even room for an extra dollar. So this is a typical scenario that I see right now. Now let's say scenario 2, same clients. So $150,000 is the income that we're qualifying them on. Want to buy a house at $750,000. They're putting a down payment of about $50,000, $50,000, 30-year amortization period. But they want to see if they could qualify for a variable rate. With a variable rate, even though it's not that much higher than a fixed rate, they're not going to qualify. They're just over the limit, which means that if they want to take the variable rate, they'll have to put a little bit of a higher down payment, because they go over their debt ratios according of what's allowed by the government's mortgage rules. When it comes to choosing between a fixed and variable rate, and just whatever mortgage you want to take in general, there are 3 rules that I always tell clients, that I always share in my webinars. There are 3 rules to follow. The first is you need to know how much you qualify for. So just because you think you could qualify for an amount doesn't mean you do. What I'm seeing a lot now is we're post-pandemic, and I'm seeing a lot of people who during the pandemic, their income was not stable, especially people who are business owners. If I was going to qualify you today, if I was going to pre-approve you today for a mortgage, or the end of 2024, I would be asking you for income documents from 2022 and 2023. And depending what industry you're in, if you're in an industry like the restaurant business, as an example, 2022, your numbers might not be that good. And then on top of that, on top of your numbers not being that great, you might have also incurred some debt, which will affect your capacity to borrow. So the first thing when making a decision on what to do when it comes to a mortgage, whether you're buying, renewing, refinancing, is what do you qualify for? The second is, what can you afford? So just because you qualify for it doesn't mean you could afford it, which is why I brought up the payment amount in scenario 1. So I gave you all the numbers, but I also gave you the amount of the mortgage, because even though on paper these people who are planning on buying can afford it and they qualify, maybe the dollar amount of the mortgage, they can't afford it. Maybe besides their mortgage payment or their home, the payments that they make in order to secure a roof over their heads, maybe they have a very active lifestyle. They spend a lot of money. I don't know, because when we qualify people on their mortgage, we're not looking at their lifestyle. We don't know if they live way beyond their means past their mortgage, and it doesn't show up. It doesn't show up anywhere. So how much do you qualify for? Can you afford your mortgage payments? And the third thing to ask yourself is, what can you stomach as a scenario? So besides qualifying, besides the mortgage payment, what's the rest of your financial situation like? Even if you're a high income earner, you could also be paycheck to paycheck. So maybe a variable rate, even though it's more attractive and it might be in the long run a better option for you, if you are paycheck to paycheck, you can't stomach any kind of variables in your budget. No matter what, you have to pay your mortgage, and maybe a variable rate isn't the best option for you right now. Maybe it will be in 3 to 5 years once you get your finances in order. So always ask yourself those 3 questions. What do you qualify for? Can you afford it? And can you stomach this as a scenario? So I went over scenario 1. I went over scenario 2. No questions in the chat. Again, if there are any questions in the chat, please pop them in. The third scenario I wanted to go over was to incorporate kind of some of these the first-time home buyers, the rules for first-time home buyers. So in scenario 3, we're looking at someone who's a little bit higher income and they want to purchase a home at $1.5 million. They are software engineers, and combined they earn $300,000 a year. They would like to put down as a down payment $150,000, which is 10% of the purchase price. Again, they would like to take a 30-year amortization period, and they would like to go on a fixed rate. Now, based on those numbers, so $1.5 million purchase price, $300,000 qualifying income, a down payment of $150,000, 30-year amortization period, we're looking at a monthly payment of about $7,000. And this is based on a fixed rate. Now, if we go to scenario 4, same numbers, same people, want to purchase for $1.5 million, $300,000 qualifying income, 10% down payment, but they want to look at the variable. It's the same thing as the other scenario that I looked at. If we look at the variable rate, they won't qualify. They're just over. Even though the spread between the fixed and the variable isn't that much, it brings them just a little bit over and they wouldn't be able to qualify. So again, just like the other scenario, if they do want to qualify, they probably would have to put a bigger down payment, in order to qualify under the allowable debt ratios. A question in the chat: for home appraisals, is it best to have it done by the bank or an official appraiser? Do you need a notary? Does this new appraisal increase the HELOC? Will the bank accept the new appraisal and increase the HELOC? So for first question, home appraisal is best to have it done by the bank or an official appraisal. Sometimes you don't have a choice and you have to go with the appraiser done with the bank. It's always at the bank's discretion. There's a misconception that the bank is going to go, that the appraisal done through the bank is going to be lower because the bank doesn't want to give you as much money. That's not necessarily true. Sometimes you don't have a choice and the bank will want you to go with their appraiser. Do you need a notary? You'll need a notary if you're doing any changes to your mortgage. So if you're looking for a home appraisal because you're refinancing and you want to pull some equity out of the home, then definitely you'll need a notary because you're changing the terms of your mortgage. I mean, anybody could request to have their property appraised. It doesn't, but not do anything with it. It doesn't mean that getting a home appraised would mean that you go to a notary. But if you're making any changes to your mortgage, yes, you will need to go to a notary. Does the new appraisal increase the HELOC? Yeah, so the point of getting an appraisal is to, generally speaking, you want to know what the market value of your property is. And normally, if it's been a few years since the last appraisal, or let's say you purchased a house and that was the last time you knew of the value of the house, the whole idea is to increase the value so that you could pull equity out of your home. Usually that's why people do it. And yes, it should increase the HELOC because hopefully the market value of your property went up. Now, if you're only doing this in a 6-month period, it doesn't guarantee that the value of your property went up in 6 months. But if we're talking about a longer period of time, then generally speaking, unless there's some type of situation like flooding or whatever it is, then the new appraisal, if it's higher than it was in the past, then it should help increase your HELOC. A HELOC, by the way, for anyone who's watching and doesn't know what it is, it's a home equity line of credit. It's basically a line of credit that uses your property as collateral. Will the bank accept this new appraisal and increase the HELOC? Again, if it's done through the bank, I mean, the bank is the one who is requesting the appraisal. If it's through another appraiser, it's at the discretion of the lender. And HELOCs are based on HELOCs, whether it's a HELOC or a mortgage. If you're refinancing, then if you're refinancing and the market value has gone up, then yes, the HELOC or the mortgage will increase. I hope that answers your question, Maria. So when we're looking at fixed rates and variable rates, you have to look at what's the dollar amount that makes a difference. So again, going back to the 3 points that I brought up, if you're trying to compare the two, you have to see what you qualify for, what you could afford, and what you could stomach as a scenario. Right now, at this moment, the spread is very small. So people are assuming that it's the right time to jump in, but you really have to take a look at your entire financial situation. Again, if you're someone who's paycheck to paycheck, no matter how much income you earn, people will assume that the more you earn, the more cash flow you have. That's not necessarily true. You have to take a look at your entire financial situation and how much risk you're willing to take. Personally, I'm a big risk taker. I'm a huge fan of variable rate mortgages, but it doesn't mean that Amy or Jenny or Maria have the same risk tolerance. So you have to look at what you could stomach as a scenario. Always look at the worst case scenario and ask yourself those questions. Let's pretend that variable rates for whatever reason skyrocket and you're going to have to cover $1,000 extra a month. Do you have that readily available? Mind you, if you have a variable rate, for the most part, you can lock it in at a fixed rate. It's not a predetermined fixed rate. It's the fixed rate at the moment that you decide that you want to lock it in. Like I said, when we started off this year, rates were much higher. The 5-year fix was about 5%. The 5-year variable was about 6%. Now we're at about 4.25% and 4.5%. So you might say to yourself, well, the people who purchased earlier this year, they might be kicking themselves because they should have waited. This is just a period of an entire amortization period. So the problem that we have right now with the news and with social media is everything is hyper emotional. We should have waited, and we have access to so much information instantaneously. Your mortgage is probably going to take you 20, 25, 30 years to pay off. And there are going to be moments that are that you're at a higher rate than other times, just like with any other investment. If you're purchasing your first home, you cannot predict when you're going to find that home. So, and I always tell this to people, you don't know if the home of your dreams is going to show up on the market tomorrow. You don't know if the home of your dreams showed up in 2022 when interest rates were super high. It goes down to the 3 points that I brought out in the first place, which was if you could qualify for it, if you could afford it. You can't put a price on that home of your dreams. You never know when that's going to show up. You just want to make sure that you qualify for the mortgage and that you could afford it. The current fixed rates have increased despite the Bank of Canada's rates decreasing. I qualify for both at this point. Are we forecasting for fixed rates to decrease? Fixed rates increased just a little bit in the last 3 weeks, since around this time in November. But since the beginning of the year, pretty much since February, they've gone down. But fixed rates don't have anything to do with the Bank of Canada rates. So I'll repeat, the Bank of Canada is our central bank. 8 times a year, they make these rate announcements that affect all variable rate loans. So that includes variable rate mortgages, lines of credit, home equity lines of credit, investment loans, student loans. Those are the big ones off the top of my head. So when the Bank of Canada makes their rate announcements, it affects these rates. When it comes to fixed rates use the Government of Canada's bond yields to determine if they go up or down. The bond market is open Monday to Friday, just like the stock market. So bond yields go up and down every day, generally. And what we look at is how they're performing. Look, if tomorrow it happens to be one of those days where bond yields go up, it doesn't necessarily mean that fixed rates will go up right away. What banks generally do is they take a look at what they predict is going to happen before they increase rates. Because for banks, if they start increasing or decreasing their fixed rates every day, it's going to be such a hassle. So what they do is they're trying to see what the trend is going to be. But fixed rates have gone down since the beginning of the year. there was, since the beginning of the year, with the exception of a few weeks ago, there was a bit of a spike. So we're still there at 4.25. At the beginning of November, fixed rates, like at least the 5-year fix, was down to about almost 4, so 4.09. And then it went back up a little bit, but now it's stabilizing. This is normal for the end of the year when it comes to bond yields and just markets in general. Are we forecasting the fixed rates to decrease? Going back to what I said, they started to decrease September of last year, and then going on until this year. So I think by next year, we'll probably get down to, I don't know, maybe hopefully the 3.5%. I don't know. We'll see by next summer. But they have gone down. They have gone down this year. They've gone down 0.75% since the beginning of this year. Are there any other questions? Awesome. So in terms of next steps and action steps, I know I'm repeating myself over and over again. You have to look at what you qualify for. Try to drown out the noise that you'll hear from, the people around you, family, friends, coworkers. Everybody's situation is different. And especially if you're not the typical situation. I know that this year in particular, I've seen a lot of entrepreneurs not qualifying for as much as they thought they would earn, mainly because their income hasn't been stable post-COVID, also because of debt that's incurred. I'm also dealing with a lot of divorce files. So again, kind of these not traditional files that you would normally think of when it comes to mortgages. So if you're thinking of buying out a spouse because you're going through divorce, if your mortgage is up for renewal, if you're thinking of refinancing, whether you're at the end of your term or the middle of your term, what do you qualify for? So whoever it is that you're working with, whether it's a mortgage specialist with the bank or a mortgage broker, or if you want to reach out to me, make sure the person you're communicating with is listening to you and understanding what your needs are and what the ultimate goal is for you. And that person should be able to tell you, listen, this is possible, but this isn't possible. We could do this, but not this, or vice versa. What do you qualify for? It boils down to the numbers and what your profile is. Next is to take a look at if you could afford it. I say this over and over again. Just because you qualify for a mortgage doesn't mean you could afford it. I saw this a lot in 2020, 2021, when mortgage rates were super low. People all of a sudden were jumping in because of fear of missing out. And people were jumping in to buy the max that they qualify for at a dirt cheap rate. Well, guess what? If you bought in 2020, 2021 at a dirt cheap rate at the highest that you could possibly qualify for, and overall you're not financially sound, you're going to be in for a rough time when your mortgage is up for renewal, either this year, next year, or the year after, because definitely your mortgage rate is going to go up by at least 1%, even if mortgage rates continue to go down. So you have to ask yourself, what can you afford, and can you stomach this scenario? There's a reason why the 5-year fixed rate is the most common type of mortgage. That's what people are comfortable with. People like to know, okay, for the next 5 years, this is what I'm paying. I don't have to break my head over it. I don't have to worry about this for the next 5 years. For the majority of people, that's what they're okay with. That's what they could stomach. If you're a risk taker like myself, or like a lot of real estate investors, we're used to the unknown. I've been an entrepreneur for most of my adult life, so every day is unknown. I'm so used to it. I'm not used to stability, so I'm the opposite of most people. I don't mind ups and downs because that's what I'm accustomed to. But for someone who is maybe a salaried employee in the corporate world and likes to know every 2 weeks I get my paycheck, and every 2 weeks I contribute to my RSPs, TFSAs, I pay my mortgage, everything is, you have your ducks in a row. Maybe something like a variable rate that's completely foreign to you, even though everybody's telling you to do it, maybe you can't sleep at night from doing it. So this is really a personal decision that you need to ask yourself, when you're trying to make a big decision like this, when it comes to your mortgage, try to sit with yourself and look at the different scenarios and ask yourself what you could stomach, even if you qualify for it, even if you could afford it. Can you stomach it at the end of the day? Because at the end of the day, it's your financial decision and your mortgage and nobody else's. So I hope this helps. If I don't see any other questions in the chat. If you are planning on purchasing, like a lot of Quebecers, if you're planning on purchasing next summer, so you're starting to look in February, March, April, you might not need to get pre-approved right away because you're not going to be on the market till, let's say, February, March, April, but at least sit down and look at your numbers to plan ahead, because you are not going to be the only one who's thinking of purchasing. You and everybody else who doesn't plan on renewing their lease is going to be is thinking of purchasing. And I know I've seen it. It's quiet right now because it's the holidays, but it's quiet right now because there are a lot of people who are waiting to purchase next year because they believe that interest rates are going to go down even more. So plan ahead and get your finances in order ahead of time. If you are not a salaried employee with a regular income, if you have any other types of situations that have a little asterisk or come with a disclaimer, reach out, please, because I don't want you to be in for a surprise when you're ready to make an offer on your first home. If your mortgage is up for renewal or you're thinking of refinancing in the next 3 to 6 months, speak to someone, reach out to me, reach out to whoever it is that you work with, and plan ahead. It's hard to say where we're going to be a year from now, but the next 3 to 6 months, we could play it by ear and at least give you some scenarios and some numbers that are tangible and that could ease your mind. So I hope that hold on one second. Is there a favorable period of the year to get a mortgage, start end of the year or spring, winter? If you're buying your first home, anytime, like I said before, you don't know when the home of your dreams, whether it's a condo or house in the city or like a chalet up north, you never know when that property is going to be listed. So anytime. The hardest time, I would say, but the most popular time for people, like the most active time for mortgage people and for realtors, is February, March, April, for mortgage people and basically buyers are trying to move into their properties in the summer. Why? Because of the famous July 1st and leases. The majority of leases in Quebec renew July 1st. So typically at the beginning of the year, that's when tenants will tell their landlords they're not renewing. Everybody's buying then. So if you want a less hectic time, the second half of the year is always easier, but you might find less inventory. When it comes to your first property or your first home, just remember it can happen at any time. Tomorrow you could wake up in the morning and the house of your dreams, it's all of a sudden been listed, and all of a sudden you're trying to find a mortgage person who's not on vacation to qualify you. And, you just never know when that's going to happen. So there really isn't an ideal time, but the busiest time is at the beginning of the year. Is after February, right up until June, July. Any other questions? Awesome. So thank you once again, everybody, for coming out and supporting. I don't know if some of you are attending for the first time, but it's been 4 years that I've been doing this. I appreciate everybody's support. Happy holidays to everybody. And yeah, it's so much fun. Looking forward to seeing some of you online or in person. Just a little bit of a heads up. Next in-person event, if you want to take it down, Sunday, March the 30th at Connections Rallia in the Plateau. Obviously, I'm going to make some announcements about it, but thank you so much to everybody and happy holidays. Hi, Dusa. Hi, Donna. Hi, everybody. Take care, everybody, and we'll see you all soon. Take care.